things we buy are products. What's the other big category of things that we pay for? Services. When we think about financial analysis, it's really the core of business. To make any business decision for an entrepreneur, for a large business, or even for a government, financial analysis is something that's critical. It allows us to look at numbers, look at data, look at information, and synthesize it all up to give us an informed opinion versus going by gut feel of how things might be happening. If we're thinking about costing, we have to think about what does the product or service actually cost me to deliver this? What are the fixed costs versus what are the variable costs? So every business venture has an element of fixed costs. These are costs like rent or having a car lease or having employees that are, the costs are always a part of the equation. No matter whether you sell 100 or you sell 1,000. You'll still have a fixed cost element. Then there's what we call variable costs, which is how much cost does each unit of something you're selling or a service you're providing actually incur for you. So depending on the volume that you sell, the margin you make on each unit needs to cover the fixed costs, of course, in order to be profitable. So if I sell something for $1, I actually buy it for 80 cents. 80 cents is my variable cost. So every time I sell that unit, I will incur 80 cents, but I'll be making 20 cents. But you don't actually make profit until those 20 cents, you accumulate enough 20 cents to actually cover what your fixed costs are. So your rent and your utilities and your lease payments for your car, etc. So additional costs could be significant. Sometimes they're not costs that you plan for or that you necessarily think are going to be big costs. Advertising and promotion for a new startup business are usually very, very heavy in terms of costs because you're getting your brand out there, you're getting your name out there, you need to get into flyers, into yellow pages, into TV ads, etc. The other cost is financing. If you look at a business that's a new startup that's gotten some financing from the bank, let's say $100,000, in that first year they may be paying upwards of $10,000 in interest, depending on what the rate is. And generally speaking, the risk that the bank takes on by giving capital to a new startup, they will demand a higher interest rate because it's a higher risk of default. Potential profit depends on how you price. Some organizations do a cost plus, so they'll look at all their costs and then they'll say, okay, it costs us $80 to make this product, let's mark it up by 20% and price it at 96 or whatever it works out to. Other companies or businesses price based on market. And some of those organizations or industries get into price competitions and then everybody ends up losing money. So I think the safest way is to look at your costs, understand your costs, and ensure that you're pricing it with enough margin to cover all your expenses. I think is the smart way to do it. As soon as you get into pricing with the competition, with no transparency of how much your services or products are actually costing you, you can easily run into a loss situation and not even know it.